QYLD is one of my favorite ETFs that I invest in. I have over $100,000 invested in it, and that pays out a pretty nice dividend every month, which I really love. But have you ever wondered exactly how they figured out what calls they're selling and how does that equate to the dividend? Well, in this video, we're going to do a quick overview of what QYLD is, and then we're actually going to look at the current call options that they sold and see how that pays out to the shareholder, as well as what gets reinvested in. So, for those of you new here, QYLD is a covered call ETF. It does on the NASDAQ 100. Basically, they own a bunch of the underlyings to simulate the index, and then they sell covered calls against it. Selling a covered call is when they promise to sell something at a certain price in the future if the stock price is higher. Except in this case, they're doing it on another index, and it's cash settled. And what that basically means is that there's no shares being transferred over. They have to settle the difference with cash. And how they do that is they sell some of the underlyings to make up that cash difference if the call option goes against them. If the call option goes for us, then QYLD keeps all the premium, and that's just extra income that gets paid out to the shareholders as well as reinvested into the fund. So it's been doing this for at least 8 years now, and obviously it pays every month. The total expense ratio is 0.6%, which is pretty low given the fact that it's giving you a lot of income every month. Obviously, QYLD, because it's selling covered calls, is not a growth ETF. Like, it should trade flat or maybe even trend slightly downwards over time. But because of the reinvestment aspect, it doesn't drop like a rock, like some people seem to think happens. When we go down here, and this is just on their main page here, you can actually see their top holdings. And something that someone messaged me about was the fact that Netflix dropped so much. So they were like happy saying like QYLD is gonna tank now. Like, no, QYLD only has like what 1% in Netflix. So if Netflix went to zero, then QYLD would only lose 1% overall. Like, that's nothing, basically. So like that's the benefit of having like this index ETF thing going on, is if one stock goes against you massively, it's not gonna kill your entire position. So actually, looking at their top holdings, Netflix even is just 0.77%, so even smaller. And like that means that if Netflix went to zero, that's the most that you would be losing. Anyway, if you go down to the bottom here, what's really neat is that it actually shows you what contract they're selling. So you can actually look that up in the charts and see how that's going. So they sold the 14050. I'm gonna go ahead and steal that and throw this in here. On the NDX for May 20th, 2022. So what you can do is you can go to that. We said the May 20th. And what strike did they do? 14050. And I'm going to copy this guy. So this is the call option that they actually sold. And then we're going to go over here to the charts and paste that. And now what you can see is the price of that option over time. So it looks like they would have sold these options on one of these 2 days here. Based on the candle here, I'm going to probably assume it was the 19th that they sold the next iteration. So if we take this and say that they got filled at like the average here, let's just say 450. We're going to go back to our sheet over here. And so we know that they made potentially 450 per option, right? 450. Make sure I'm not putting the wrong number in there. So the total contracts, what's nice is they also tell you that. So 5269. We can go ahead and plug that in. The total money collected, like this is what's really cool about QYLD, is they made that, since these are option contracts, you multiply that by 100 times the amount of contracts. So when they sold that covered call, QYLD took in $237 million. Now what QYLD does is they take 1/3 of that and they pay it out as a dividend for the share for the investors. and then the other 2/3 goes into buy back the contract and buy more of the underlying when everything is said and done. So the dividend we can expect to be someplace around here, times 1 divided by 3. And then the total amount of money for reinvestment, and that would actually be 2/3. Let's go ahead and format this as money, because why not? Make it look a little better. So assuming that they got filled at $4.50 a contract, which might be a little high, you would think that the dividend being paid out would be 0.23. Now, if you look at the entire bar here, I mean, it could be anywhere between those. So like 362. So let's go ahead and see what that would look like. And that's like kind of the minimum that was trading that day. So 18. So you know it's going to be someplace between 23 and 18. If you average those together, you get about 20 cents again. So that's how you can see what the dividend's going to look like. This also gives you something to root for. Ideally, you want the NDX to finish just under this strike. And that's when everything works the best. But it can go above that. And as long as the NDX does not go above, well, this plus this. We said this was 450. So basically for QYLD, before the break even is breached, it's 14,500. So if NDX stays below that, then the call's made money for QYLD, which is pretty cool. All this income that comes out here is taxed like normal income because it's just like selling options. The exception would be if NDX goes up above and breaches this, and then they have to sell shares to pay out for the dividend. That's when you get the return of capital part. And that's why a lot of people originally invested in QYLD, because they thought everything was tax-free based on, I think it was 2020. And then the next tax year, people got surprised when they had to pay taxes on all the shares that they got. So that's just something to be aware of. They update this every day. I think it's 1 day behind. So you can follow along and see how the holdings are. The other thing I was looking at was this. Like, the component for selling the covered calls and closing is clearly outlined. There's not much thought process or variation. It's just kind of a passive thing that they do. So generally they close the previous one the day before it expires, which is usually the Thursday. And then once that settles, they sell the next covered call 1 strike above whatever the NDX was weighted or closed at the following day. So it's very passive on what they're doing, very easily to replicate, but you need a lot of money to do it, and just buying shares at like $20 a pop gets you the same results, minus a little 0.6% over the course of a year. Something else I thought was neat was just kind of looking at these little graphs here. Basically, if the market goes down, QYLD does good. If it stays flat, QYLD does really good. If the market goes up, that's when you are giving up capital appreciation a little bit, but you are sacrificing potential growth to get that monthly income, which is great for people that are nearing retirement or use this to actually pay their bills. And there's one more thing I wanted to talk about. Well, I guess the beta ratio here was just kind of neat to point out, but all this information is available on their website, so if you invest in it, go ahead and go read it. Like, it's some interesting stuff to go dig through. I hope that by watching this, you understand a little bit more about what the covered call is doing and how they generate their income. And I'm going to continue to leave my position there and let it keep dripping and enjoy seeing that passive income come in every month. I hope you guys enjoyed this video. If you did, like and share, and see you guys next time.